Lennox, resource analyst at Fat Profits, joins in on the show right now. David, hi, good morning. Good to have you on the show. David, everything is coming down across asset classes, but for crude, it continues to be around 112. Why so?
Well, look, certainly if you have a look at the broader crude market, there are a couple of factors that are just keeping that tension in the oil price, and that primarily is that we've still got concerns over the supply of crude. Obviously, we're well aware now of the Ukraine-Russian war and what that's doing to the disruption of supply around the world, and that's still keeping tension inside the oil price. You've also got the fact that we're moving towards probably what's going to be a fairly good US drive season as we come up to their Independence Day holiday, and we would expect that we'll see significant demand coming out of the US, either from driving or from flying. So one or the other, we expect to see that demand adding extra pressure to the oil price. With the fall that we've seen in inventories, that's really completed the good environment that we've seen for higher energy prices over the course of the last few weeks.
David, the bulls are arguing that there is no crude available, which is supply is a challenge. Is that a realistic assumption?
Look, if there was certainly a view that there was no supply of oil available, then the oil price wouldn't be sitting where it is now. It'd be well and truly heading towards a couple of $100. So look, we think that there certainly is. If there was a real crunch coming in the oil price and it did start to surge a lot higher, we would start to see US production coming back on stream. Certainly they're well below their record highs that we saw of the last couple of years. And we're also well aware that Iran can probably, by the end of this year, put something like 1.2 to 1.3 million barrels back into the system if we can see some deal on their uranium progress. So look, overall, there's certainly supply there. It's just that at this point in time, a lot of it's pending what we see in terms of movements in the crude prices. It's not been enough to bring some of those productions back on, but certainly if it was lacking, then we'd see the oil price way higher than where it is now.
David, what is your understanding of the speculative power in the oil market? Because when an asset prices goes higher, obviously more than the actual underlying demand, it is the speculators which create demand and volatility. Is there a bubble in making because of the leverage positions in oil?
Look, if you have a look at the overall speculative end of the market, we certainly do think that, yes, that has a very big part in the peaks that we generally see in all asset classes. It's the fear that investors get that they're missing out on something. So, of course, when they see that momentum start to grow and grow and grow and send the asset class prices higher, they tend to all flock in. So, yes, that's certainly a valid point. We've probably seen that certainly on numerous occasions, certainly back last year in early February when the oil price went to negative. That was certainly speculatively driven. So, look, overall, we do think that speculators have a part to play. With the positions that we've seen open, we're not expecting that we'll see any significant moves by the speculative end of the market unless we see something drastic happening. And at this point in time, we're well aware of what's happening inside the Ukraine and Russia. We're well aware of what OPEC's producing. We know that Iran may come back on stream with an extra 1.2 to 1.3 million barrels. So we would need something outside of that to drive that speculative edge higher.
Good morning. So on Thursday, US President Joe Biden has summoned 7 oil companies, right, to talk about bringing down fuel prices. There are reports that are coming in from the United States source space that maybe the US is also going to look at removing a federal tax to just bring down the cost of fuel. So if you're going to see this kind of action that's going to take place in the US, where do you see the oil prices then settling at? $100? Can it be below $100? Is that what the US's game plan could be?
Look, certainly we're well aware that the one thing that's not liked inside the US is high gasoline prices. And every president since gasoline became I guess, a well-traded commodity inside the US, that they've always tried to keep those prices down. One would suspect that, yes, the president will talk to those major US producers and ask them to probably try and extract more from the fields that they've got. But at this point in time, it really is the fact that the oil price is not significant enough for them to turn a profit on their production. So one would expect that we would need to see somewhat of a support from either more of a lift in demand to get those prices higher, or in fact that perhaps some of those other producing nations move away from production and they do in fact start closing in their production to lift those prices higher. Oil companies aren't going to give the oil away. They really do have to make a profit for their shareholders. So that's what the big oil companies in the US will be aiming for. But certainly that tax that we've seen, if we do see that come out, then that will obviously instantly reduce the petrol and gasoline prices across the US, and that would put some I guess, confidence inside the demand for US, and we may see that rise. But that's really only a short-term fix, we believe.
Short-term fix. You have to keep a watch out on that meeting as well with the US President Joe Biden summoning 7 oil companies to talk about fuel prices. What we've also started, of course, to see is look at the double top when it comes to the dollar index. Currencies that are depreciating against the US dollar. Gold prices are also coming down, as are other commodity prices. For the second half of this year, the second half of 2022, is this a trend that we're likely to see? Crude stays around $100 a barrel, gold starts trending down, and US dollar gains strength.
No, we've certainly been on the opposite side of that call. We've expected the US dollar to weaken, and unfortunately through the first half of this year it hasn't. But the metrics that are there, that is rising debt, certainly stable and persistently high inflation, they are the two key metrics that we believe will drive the gold price not lower but higher over the course of the rest of this year. And that's because we think the US dollar, with those metrics in place, should actually be falling, not rising. We continue to see that debt pool rising. We've now got forecasts that US GDP is going to slow, so that raises their GDP to debt ratios to significantly higher levels. The only factor that continues to be a fly in the ointment is that we haven't seen, as you've suggested, those other major currencies actually starting to appreciate. It's been a safe haven aspect that's keeping that US dollar higher. You can lose less in the US dollar than perhaps investing in the euro or in the pound, and really that's what's keeping that dollar higher. We're expecting it to fall, so we'd expect to see gold prices over the rest of this year rising again and perhaps even challenge that 2100 high again.
Right. David, good to have you on the show today and get in some perspective on crude, because that's something, frankly, that no one can make sense of as to why it continues to hold strong.